I've had several really good questions come in this week, and I'm going to try and tackle them in order here. First one says, with the country being in recession, even though the government states it's not a recession, the dollar being devalued, interest rates rising, inflation going through the roof, what strategies is Shadow Ridge using to protect my portfolio from destruction when all these factors come to fruition? This is a great question. It speaks to an awful lot of what I hear from clients, not every day, but frequently with these different types of concerns. One of the things this suggests to me is people with these concerns might be watching a little too much cable news. We have to remember that their goal is not to make you a better investor. Their goal is to get you stirred up and upset. There's research that shows that most people would rather have a negative emotion than no emotion at all. And the media plays to this. So they're constantly trying to stir you up with things that are disturbing but not actionable. So my best advice is watch a little less cable news. It can make you crazy. But to get to your point, I like to invest by looking at the data rather than relying on some opinion of a talking head. Chart number one speaks to your point of dollar devaluation. I assume you're meaning inflation, because inflation does devalue the dollars. You can buy less with the same amount of dollars after inflation has done its work. This is a 5-year chart showing inflation, and you can see that it peaked last summer at about 9.1% year over year. Inflation's dropped quite a bit since then. It was, I think, 4.9 earlier this week, maybe yesterday. This doesn't mean that prices are dropping. It means they're going up more slowly. Now, I expect inflation to stay high for a number of years. There's studies that show that once inflation has reached 8%, like it did last year, it takes many years to get it to stabilize underneath 4%. It might dip down there occasionally, but to get down there below 4% and stay can take several years. So we've got more inflation in our future. However, there's a different way to look at the devaluation of the dollar. Chart number 2 shows the value of the dollar compared to other currencies throughout the world. In fact, the dollar is high. It's almost as high as it's ever been in the last 10 years, at least. It's down a little bit from last summer, but still really, really high. And so what this tells us is that we don't need to worry too much about that type of dollar devaluation. But as your question suggests, there's so many variables out there that no one can predict how this combination is going to affect the markets. In fact, if someone tells you that they know how all this is going to shake out, my advice is to put your hand on your wallet and back slowly out of the room, because those people don't know. They're just probably trying to sell you something. How the market's going to react is really a human nature type of question of when we're going to reach a tipping point when investors say, I'm concerned enough, I just want to back off and watch. I don't want to invest right now. This causes an imbalance of buyers and sellers. When there's fewer buyers, an ordinary number of sellers can drive the market down. And no one knows when we're going to reach that kind of a tipping point that will drive prices down. And for this reason, trying to predict the unknowable is something we just don't do at Shadow Ridge. We wait until we see current events actually affecting the market for certain things like stocks or bonds. And then we do what our data tells us to do, only when we see what's actually happening. And usually we've already done this before you even realize that there's a problem. Don't spend too much time worrying about that. At this moment, cash and money market funds are the largest holdings in our client accounts. And that tells you what we think about investing in this market. Have another question. With the dollar most likely not going to be the reserve currency and a potential central bank digital currency like a digital dollar, how will this impact the current and historical method of financial investments? Will there be a new opportunity for digital assets acquisitions or other tangible assets such as gold or silver? This is another really good question, especially on the heels of my article 2 weeks ago in the Shadow Ridge newsletter that spoke about the debt ceiling fight going on in Congress. This is all about money and what it's going to be doing in the economy. Now, first, let me explain for people who might not be familiar with the term, reserve currencies are just the cash savings that other countries hold for contingencies. Now, the dollar is the world's leading reserve currency by far. It became the reserve currency of the world in the wake of World War II, when we had the only economy that wasn't bombed into smithereens. And that makes a lot of sense that you'd want to put your savings in the hands of the only stable entity that was left after something like that World War. These days, there's other strong economies out there, and it makes sense for countries to diversify their currency holdings. Diversification is a basic tenet of financial planning, and countries can follow some of these things too. Pundits try to make a little too much out of this, and often it's for political reasons. Now, although countries may diversify somewhat into other currencies, no countries are really abandoning the dollar. Let's take a look at China. It's the second largest economy in the world. You think it would be the second largest reserve currency, and it's pretty close. And I can't remember where I read this about 10 days ago, but only 4% of global financial reserves are denominated in yuan. The vast majority are denominated in dollars. And there's a little bit in euros and a little bit in British pounds, but dollars are the huge elephant in the room, if you will. So a complete transition away from the dollar as a primary currency reserve is going to take a long time, perhaps generations to unfold if it ever does. So I would relax. Nothing's going to happen so quickly in this department that's going to catch us by surprise. The timing gives us all plenty of opportunity to see when things actually begin to affect our economy, and we can make adjustments there depending on what the data tells us. I want to touch a little economics thing for a moment. There's three reasons why people want to hold one currency over another. And this is true for individuals as well as for countries. The first is economic strength. Now, the U.S. has clearly the largest economy in the world. We have for a long time, and it's probably not going to change too quickly. The second would be military power to back up that economy, to protect that economy. And the U.S. has the largest, strongest military in the world. The third is political stability. And despite the clown show that we see in Washington on a frequent basis, our country is more stable politically than any other country in the world. Even people look at China and say, well, they're pretty stable over there. But you get leaders of industry and politics who just disappear overnight. When you do something the government doesn't like, it just wipes you out. That's not stability. That's a big risk. So there may be countries that can approach the U.S. in one or two of these areas. Nobody matches us in all three, and none of them, no areas are we really surpassed. So I would relax, and I don't believe the dollar is going away anytime soon. Regarding your question on gold and digital currencies, gold has finally just gotten back to the level in the past few months where it was in 2011. I mean, that's 12 years ago. And touched these levels briefly in 2020, and now it's finally just getting back. This is not characteristic of what we'd expect of gold if we were having an imminent currency collapse. So that's one thing that argues strongly against the fact that we're facing a currency collapse. Bitcoin and other digital currencies, in my opinion, are really misnamed. They're not currencies, they're speculative assets. To be considered a currency, something has to be widely accepted, has to be, and how many stores do you know that accept Bitcoins? I don't know of any. They have to be easily transferred. And when I say easy, think about when you're standing in the grocery store line and you plug in your Visa card, and in 2 seconds it says remove your card, you're done, and there's no cost to you. Okay, that's easy. If you want to transfer Bitcoin, it takes from 5 to 15 minutes, and the cost is in the teens of dollars for each transaction to be settled. That's not an easy transfer. The third thing is you have to have a stable value to have something be considered a real currency. And Bitcoin and other digital currencies are anything but stable. So these things are just speculative assets. They're not likely to be accepted as currencies in the near future. Now, we have seen a number of countries institute central bank sponsored digital currencies in their dollars. Most recently was Zimbabwe. Now, I have on my wall over here a $10 trillion Zimbabwe note that I bought for $5 a few years ago. They need something different, and this is their chance. But it's a local thing in Zimbabwe. Our Federal Reserve is studying the idea of a digital currency, and in a few years we may see something like that. I'm sure the government would love to do something like that, but because it's going to be denominated in dollars and tied to the value of the current dollar, I don't expect there to be a lot of investment potential in that because there's not going to be any difference in values to play off of. A U.S. central bank dollar, the government may love it because they're going to get to see where everyone spends their money. But the civil libertarians, the citizens, not going to like it very much at all, I expect. Another caller asked, given the current state of economic uncertainties, including items such as the national debt, bank liquidity problems, business failures, corporate downsizing, and weakness in the real estate market, what's the best short and long-term investment strategy? Frankly, it's tempting to go to cash with options of 5% interest rate. Well, obviously, we're avoiding bank stocks based on the litany of problems you just ticked off for us there. Banks do have problems. People are pulling money out as they can go to get higher rates elsewhere. Most banks have been squeezing those nickels and offering 0.5% when people get 3, 4, 5% elsewhere. These outflows have a number of effects on banks. Banks can loan about 10 times the amount that they have on deposit. If people start cutting deposits back, that ratchets down the amount of loans a bank can make dramatically. That 10 times leverage works against the bank in that situation, really crimping their revenue from these loans. The other thing is if enough people pull their money out, it starts to look like a bank run. And that can literally cause failure if a bank can't liquidate assets to get their balance between loans and cash assets back in balance. Commercial real estate is a real problem, especially for regional banks who made most of the commercial real estate loans for office buildings and shopping centers and things like that, which now have seen the internet take over the shopping business, and people aren't going back to work in offices after COVID, by maybe 50% of that. This is a real problem for owners and the people who carry the mortgages on those, which are commercial banks. This is going to be a headwind for banks for a number of years now. And we're avoiding banks with the exception of one. The largest bank in the business, JP Morgan, was probably going to be the last bank standing. They've been the one to be bailing out, taking the assets over a number of these commercial banks. Their prospects are pretty good, in my opinion. In full disclosure, we do own that in our future technologies portfolio. Regarding your attraction of 5% rates on treasury bills, we're holding the majority of our non-invested client assets in government money market funds that are now paying in the 4% range. And those payments, those yields, dividend yields are going up as the money market funds or the treasury bills that they bought with a 3 or 6 month, 9-month maturity are rolling over and being reinvested at current rates. The yields are coming up. So they'll follow the advertised T-bill rate, which is now a little over 5%. So there's really no need to go elsewhere to have your cash working as well as it can on the sidelines. More importantly, moving out of the market to go into 5% treasury bills or something like that requires 2 market timing steps to be successful. First of all, you have to know when to get out. And many people will get out too early and miss a significant rally in the market before it really starts to turn down in a meaningful way. Right now, the market hasn't turned down, but a lot of people are thinking like this questioner that maybe I should move out. We don't know when the market's going to turn down. So that's very difficult to time that aspect of the market. The second thing is you have to know when to get back in. The biggest returns are early in a bear market, right after the bottom. And most people aren't going to be aware of that for months and sometimes years afterwards. I have clients that have moved some assets out of the market in 2020 and still aren't back in. They just don't know when to get back in because now the market seems high compared to them. So you have to be right twice. We take care of all of that by looking at the data every day that tells us whether to be in or whether to be out. And you don't have to worry about it.